Today's video is all about how you can start making money with stocks, even if you're new to this game. Ready to learn? Let's dive in. Making money through stock investments. To generate profits through stock investments, it's crucial to address the persistent issue of inflation. Over the past 6 decades, inflation has averaged approximately 3.8% annually. Without investments outpacing this rate, individuals essentially lose purchasing power over time. Ideally, a savings account offering an annual return of 8% to 10% would be ideal, enabling both the beating of inflation and earning a profit. However, such lucrative savings accounts are virtually non-existent. The solution lies in investing in the stock market. A stock represents a fractional ownership stake in a company. When an individual purchases a stock, they essentially become a shareholder, making them eligible for a share of the company's profits. There are primarily 2 ways to make money as a shareholder. Firstly, if the stock's price increases during the ownership period, it can be sold at a profit. Secondly, dividends are periodic payments made to shareholders. While not all stocks pay dividends, those that do provide a source of income without necessitating the sale of the stock. Now, let's talk about the power of compound interest. The true magic of investing unfolds when multiple stocks grow at an average rate of 10% annually. This phenomenon is known as compound interest, which entails the snowball effect of interest earned on top of previously accumulated interest. It's akin to a financial virtuous cycle that can significantly amplify returns over time. To comprehend the potency of compound interest, consider a scenario. If an individual could invest $250 per month at an 8% annual return, after 42 years, they would amass a $1 million portfolio. Continuing this approach for an additional decade would yield over $2 million. While historical averages support this concept, it's essential to remember that past performance doesn't guarantee future results. Determining when to start investing. The question of when to commence investing is pivotal. The answer is simple. The sooner, the better. Starting early offers investments more time to grow and compound. However, life often presents obstacles that hinder investment opportunities. Establishing a structured approach is essential. First and foremost, individuals should prioritize paying off high-interest debts, such as credit card balances. The logic is straightforward. It makes little sense to aim for a 10% return in the stock market when paying 15% interest to credit card companies. Secondly, building an emergency fund is imperative, typically covering 3 to 6 months of living expenses. This safety net prevents the forced sale of investments during emergencies, which could impede progress. Determining the ideal investment amount is a common concern. While some advocate for investing as much as possible, an alternate perspective suggests a balanced approach. The 70-20-10 rule proposes dividing finances into 3 categories: 70% for living expenses, 20% for investments, and 10% for personal enjoyment. Research indicates that adhering to this allocation structure equips individuals to navigate life's ups and downs more effectively while gaining an advantage. Timing and investment strategies. Timing and investment strategies often revolve around 2 key approaches: technical and fundamental analysis. Short-term day traders primarily focus on technical aspects like charts and patterns to predict stock price changes. On the other hand, long-term investors, like the individual in question, prioritize the fundamentals of a company, including financial health, leadership, and brand recognition, to gauge long-term success. This long-term approach entails holding stocks for extended periods, typically 2 to 5 years or more. While occasionally monitoring stock charts can be beneficial, this approach has yielded positive results, particularly when compared to frequent buying and selling. Now, before we move on, if you're enjoying this video so far, please take a moment to give it a thumbs up and consider subscribing to our channel. Now, let's resume and get back to our topic. Now, let's talk about index funds. The majority of the individual's investments are allocated to index funds, which are a diversified selection of stocks. This strategy aligns with a more passive investment approach, emphasizing a broader market representation rather than individual stock selection. What exactly is an index fund? It's like a secret weapon that empowers ordinary individuals to potentially earn more than the professionals in the finance world, and it requires very little effort. Think of an index fund like a sports league table. Teams' standings on the table change based on their performance. If they excel, they climb higher. If they perform poorly, they risk being relegated. Now, apply this concept to companies and you've got an index. Take, for example, the S&P 500, a list of approximately 500 of the largest publicly traded companies in the United States. Think of these companies as the big dogs of the business world, with giants like Amazon, Google, Apple, and Tesla leading the pack. Just like in a sports league table, companies that falter might find themselves removed from this index. While you could potentially buy individual stocks from this list, it comes with risks. If one of the companies you pick performs poorly, you could lose your investment. Here's where index funds come into play. They offer a clever solution by allowing you to invest in all the companies on the list with a single click. Even if a few companies underperform, their impact is diluted by the others that are doing exceptionally well. Over the last decade, the S&P 500 has delivered an average annual return of 13.6%. Remarkably, those who have held an S&P 500 index fund for more than 20 years have never lost money, providing substantial evidence for the power of index funds. Selecting the right index fund. When introducing people to index funds, it frequently astounds them. However, when they navigate investment platforms, the array of options can be bewildering, leading to questions like, what's the best index fund to invest in? While not offering financial advice, the individual shares their personal experience with 3 types of index funds that have served them well. Type 1. S&P 500 Index Fund. The first type is a fund that tracks the S&P 500 index. This is the one mentioned earlier, known for its historical returns of 8 to 10% annually. Thanks to the magic of compound interest, it's essential to note that the S&P 500 covers 11 different industries or sectors, with none exceeding 30% of the index. However, tech stocks have gained prominence, accounting for 23% of the entire fund. Whether this tech-heavy composition is viewed as an advantage or drawback is subjective, but the individual personally believes in the future of technology. A variety of index funds track the S&P 500, including the VFIAX Index Fund and VOO ETF in the USA and the VUSA ETF in the UK. Type 2. Total Stock Market Index. The second type is the Total Stock Market Index. Over the past decade, it has provided investors with an average annual return of 13%, making it a compelling choice. This index epitomizes diversification, offering broad market exposure at a low cost. It's an excellent option for those who want to invest without continuous monitoring, as it essentially represents a stake in the entire market. While individual stocks might shine independently, their impact within the index fund is determined by their market performance. The VTSAX Index Fund and VTI ETF USA and the VWRL ETF UK are some prominent examples. Type 3. Emerging Markets Index. The third type focuses on emerging markets. These markets are poised for growth, and even if one doesn't completely agree with this outlook, having some exposure to them can be wise. China, for instance, has seen remarkable growth over the years, and this trend might continue. Emerging market index funds include stocks from various growing markets, and they can be heavily weighted toward Chinese companies. Given the potential of these markets, allocating a small portion of one's investments to them makes sense. Notable options include the VEIEX ETF USA and the VFEM ETF UK. Understanding risk in investing. Now, the elephant in the room. Is investing risky? Risk perception varies from person to person. While there's the fear of losing money, it's essential to realize that not investing also carries a form of risk. If one maintains a diversified portfolio of index funds and continues to invest steadily, historical data suggests they can weather market crashes. To mitigate risk further, consider mixing bonds into your stock portfolio, especially as retirement approaches. While bonds offer stability compared to stocks, they can also be bought on the same investment platforms. In one's younger years, taking the risk of not taking enough risk could be the biggest risk. And there you have it, folks. We hope you've had as much fun learning about investing as we did sharing these insights. Now, here's a little challenge for you. In the comments section below, let us know your favorite stock market success story or your burning investing question. And of course, if you found this video helpful, don't forget to smash that like button and hit subscribe for more awesome content. Happy investing, and remember, your financial journey begins with that first step.